Hello, everybody, and welcome to another episode of the Capital Gains Tax Solutions podcast, where, as always, we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way to exit your highly appreciated assets tax deferred so you can create, preserve, and grow your wealth. I'm your co-host, Pearson York, filling in for Brett Schwartz. In each episode, I'm joined by some of the best business, real estate, leadership, and wealth individuals in the world to share ideas, deal stories, and inspirations so together we can make complex tax deferral strategies simple and passive income plans achievable. As always, we're streaming on expertcresecrets.com, the Capital Gains Tax Solutions YouTube channel, the Kingdom Luxury Realty YouTube channel, and the Kingdom Luxury Realty Facebook channel. So please rate, review, subscribe, hit the thumbs up, like button, notification bell, all that fun stuff. And I'm super excited about our next guest. He's the executive VP of the U.S. Energy Development Corporation. He's one of the managing partners. He's been doing it for 20 years. They specialize in tax planning, family business, oil, and gas. And we're going to learn a ton of information from him. Good friend, Matthew Ike. How you doing, Matt?
I'm great. How about you?
I'm doing super well, super well. Thanks for coming on. I really appreciate your time. And tell everybody, how did you get into energy?
Through nepotism, actually. So ironically, I started off my life as a financial advisor, loved what I did, ended up selling my practice in the early 2000s. And my father-in-law happened to own an oil and gas and a real estate company. And he called me Kramer. One day I showed up and I never left. So it's been an unbelievable almost 20 years, but I come from a financial planning background, and really what I did is bring to the table kind of the expertise of wealth planning, tax structure, underwriting to an already fantastic enterprise in the energy space.
So was your father-in-law?
Yes.
Was it a Rockefeller?
No.
I'm just kidding. I'm just kidding. All right. Well, so basically just taking what you already knew in the financial planning space and basically bringing just a value add to your old man, basically to try and prove that you're good enough for his daughter, huh?
Yeah, well, I was never good enough for his daughter. There's no question about that. He was definitely right. But I was lucky enough that she fell for me. So it's really interesting because the financial planning mechanisms and the tax law that adjoin energy is just spectacular. And it works so well as an arrow in the quiver for financial planning. Instead of just a pure asset allocation tool, the ability to utilize energy and segregate all the different tax benefits into all those different buckets is amazing. And I don't think most people are aware that energy investments can be done through 1031 exchanges. They can be done through opportunity zones. They can be done through tax structure partnerships. There's just a whole mechanism, an open architecture that couples with energy that's just fantastic.
Let's just get right into some of those. Give me an example. What's one of your favorite deal stories that you've done that was just like a home run that you used energy to solve a huge problem?
Yeah, so I'm going to try, just because we're in the private place business, so I'll skip our specifics and be specific about the tax law and what happens and all
Sure.
the underwriting. So my favorite by far right now is opportunity zones. I feel like it's the single greatest tax law ever written, and I think most people think about opportunity zones as specific for energy or for real estate, but they don't realize that opportunity zones and opportunity zone funds, and then the sub-entities, opportunity zone businesses, can really invest in a host of assets, including energy. And the pairing of how well oil and gas works with opportunity zones is just fantastic, because you're able to stack these tax benefits that come with oil and gas onto those of opportunity zones. And it tends to have a lot of the benefits that people miss in real estate. So it really complements it in financial planning where people will do some opportunity zones in real estate and some in oil and gas, because oil and gas tends to generate much quicker cash flow. So you're usually generating cash flow in 6 months plus, versus having to wait 2, 3, 4 years under original use or substantial improvement in a real estate building. You can do it really, really quickly in energy. So short-term cash flow, all the tax benefits that are afforded to oil and gas tend to stay suspended in the funds, and they come out with revenue, in essence, creating like a pig pail that creates like a tax-free revenue stream or tax deferred during the life cycle. And then also in 2026, when the tax bill comes due from the deferral of an opportunity zone, the suspended losses flow through and create even more losses. So it's just this amazing pairing where all the intangible drilling costs, depletion, depreciation, everything that comes in energy butts up with that opportunity zone law, and you get this investment that's just able to compound and reinvest. And the single greatest thing is when you overlay all those census tracts, the best reserves in the U.S. most of them are opportunity zones. So there's an unlimited investment paradigm in the energy space to focus on. Instead of trying to find diamonds in the rough, there's trillions of dollars of capital that aren't being utilized as the opportunity zone tax law. I lost your audio there for a second. I don't know if you can hear me.
Okay, so let me try and make sure I got this. So you are saying that there is an abundance of land out there in opportunity zones where you can tap into the oil and gas. I'm assuming that's like some sort of like mineral rights or like or drilling or something like that. Where how do you where explain the how do you generate revenue off of the land and energy?
So the opportunity zone tax law, you have to do, as you probably know very well, have to do a couple of things. You either have to substantially improve it or put it into original use.
Okay.
So the original use concept is really easy when you're drilling new wells. You can do it through pipelines by building new pipelines. You can do it through a source of other mechanisms. But the easiest way at this juncture is to actually just drill new wells, which creates the original use. You're normally cash flowing within 6 months. And the only real limitation is because of the outside basis rules. You're usually limiting distributions to whatever rate you can create outside basis. And not to get too tax sensitive, but that's usually 6, 8, 10% that firms who understand op zones will limit the distributions. And in today's market, they're probably earning triple, quadruple, quintuple that amount and reinvesting back into more and more wells. So you get a portfolio growth along with current income. Is usually very, very hard to do under the normal thought process of how opportunity zones work in real estate.
Okay, so as someone who does full transparency, I don't know anything about like the oil and gas fields. I don't know how they work. I see the little like horse drillers, that we got. So is that what we're talking about? We're talking about you guys buying a bunch of land and putting a bunch of like those drills and those rigs on it, and then that's basically pumping the oil and then you're shipping it off and you're selling it.
Yeah, so it's really what they call E&P, exploration and production, but it's pretty much developmental areas. These aren't high risk areas. These are the shale plays that you hear a lot about. Everything from the gas shale to the oil shale plays. In fact, the Permian Basin is littered with opportunity zones. Most of it is an opportunity zone, which is the biggest producing basin in the U.S. And so it's just this great concept that you go drill a well on that census tract. It generates revenue for the community, taxation for the community, right? So you're doing the part the opportunity zone is supposed to do. And then on top of it, the investors are potentially making fantastic returns in the energy space, depending on who they invest with, what the underwriting is, the rest of it. Yeah.
Okay, so you're telling me that there's an abundance of oil-rich land out there that you can tap into with an opportunity zone. Most of them are in opportunity zones, so you're not having to go out and find diamonds in the rough or deals that are underwriting 150, 175, whatever deals before you find one. You can literally just like go at. There's abundant of these deals. You're basically flipping your cash into these opportunity zones. You're buying rigs and you're starting to drill. You're cash flowing within 6 months, and then you're taking that capital. And once that opportunity zone comes due, you have some tax benefits along the way with the oil and with the gas that pair up with the opportunity zone. So ultimately, you have a significant amount of losses at the end that you can write off against a whole bunch of other assets. Is that what you're saying?
That's exactly what I'm saying. Yeah, it's a really amazing tax concept. Assuming you like, the underwriting and the assets and whatnot, which is a whole technical part of the energy space, obviously. The tax law butts up with energy, I think, better than any other asset class.
That is super interesting. Okay, so then is it just with oil, or does this work with like solar or like wind farms or
Yeah.
Let's dive into that a little bit.
Wind. So the only problem I would say with solar and wind is the economics are tighter. So the underlying economics often are based on tax credits. So the people who can utilize the tax credits in solar, renewables, wind tend to be C corps, not necessarily individuals. So if you're investing through some type of corporation and you want both tax credits from renewables and you want the opportunity zone benefit, the real problem is I actually think it does pair well in the sense that you're hoping for the value to go up over time as people value renewables more. And after 10 years, the real benefit of op zones is the tax-free nature of all the return. So assuming that people value, renewables at a higher rate in the future than they do today, it could be a great play, probably a much higher risk play than the current income side, and really limited for those who either need passive tax credits or for corporations that don't care about passive versus active write-offs.
Okay, so how does this work? Walk me through the process.
Yeah, so an investor
liquidating a building or something.
Any other opportunity zone fund, right? They would have the same need for a capital gain deferral. So they'd have an event, they'd take the difference between their basis and the gain, and they'd throw the gain into an opportunity zone, take their basis out, right? So you're only investing the portion of your amount that's gain or some portion of that. You defer your taxes till 2026 on that gain. And inside of it, you will invest in either, in your case, renewables or oil and gas on those census tracts. And then that underlying investment will generate cash flow. It'll pay out to the investors. Over 10 years, you're appreciating your asset either by drilling new wells in oil and gas or by the hopeful appreciation of the kilowatt hours and how much you charge in a renewable. At the end of the year, you sell it. It's all tax-free after that point in time. So it's very similar to real estate. It just happens to work. In my mind, it works better in oil right now than natural gas. And the only reason is there's a lot more census tracts that are in oil-rich regions, in the safest, best return profile regions, like the Permian Basin. Natural gas has a lot of it, but it's more sporadic. So, and they were done through a lot of the blue states that chose a lot more urban centers than rural areas. And as you probably know, natural gas tends to fall in more rural areas than in urban centers. So, in PA and New York, you can't really drill in New York at all. So even though there's opportunity zones, you can't drill for the gas wells because they banned it. So it depends on the state and the area, but it works for all assets.
Yeah, that's interesting. So as far as like an investor return, right? Not to get political or anything like that, but gas is super expensive right now, right? Like oil is super expensive right now. So is that benefiting the oil driller right now significantly, or like are their returns just like skyrocketing, or like what's?
Yeah, I can't speak for everyone, but generically the industry, whether it's publicly or privately traded, the return profiles that you anticipated, you're quadruple your profiles, right? You're getting way more profit than you anticipated. Now, on a go-forward basis, that's not always true because as prices rise, costs rise.
Of course.
Right. So when you're doing new activities, you're going to have a higher cost. So your margins are going to compress over time. They're still really rich because ultimately people aren't drilling enough. And you really can't drill enough with the infrastructure and all the political backlash to really lower price. So you're probably, and I'm not making a macro statement, but probably in a pretty good, healthy part of the cycle for the next 7 to 10 years in the energy space, whether you're oil or natural gas. And natural gas probably has a better 10-year run even than oil. Even though oil is really high right now. And ultimately because oil or natural gas is ultimately, the renewable transition is going to require natural gas to feed almost all the electricity that we're talking about, right? The rest of the renewables can't create enough to meet demand. If everyone wants to go EV, you need 50 times the natural gas production that we have now.
So So then how much are these little like horse rig things pumping out? And are you leasing
Talking
the
about the pump
ground?
jack. Yeah, so a pump jack is something that's put on a well typically after the flushest part of production. So when you drill a well, your initial production will come out, and you'll usually have ESPs, what are submersible pumps. You don't see those. And after that period of time, could be a couple of years in, you put a pump jack on. And what that does is it creates pressure. It creates pressure down the wellbore because oil and gas are trapped inside the well deep down, and you got to create the right pressure to get that oil and gas back up the wellbore. So that comes in a couple of years.
You're basically creating like a little hydraulic like thing down in the ground.
It's a pump. Yeah, that's it.
Interesting. Okay. So then if you are you leasing the ground to these people, or are you buying the equipment? How is that structured?
It's all over the map. There's no one answer for companies, right? So normally what's happening is oil companies are leasing the land. And when you're leasing the land, then the landowner is going to take mineral rights or royalties on the land. Yeah. And then the operators and the investors are going to take the revenue that comes from the wellbores. So it's going to be kind of an economic split. And the royalty, the landowner will take anywhere from 15 to 25% of the revenue, and the rest will go to the operators and the investors that own the wellbores and are pulling up those mineral rights. You literally sell it into either pipeline or truck it. And that's how you get the revenue from it.
So okay. So we have a liquidity event, right? We go buy a tract of land out in an opportunity zone, and I come to Matt. I'm like, Matt, do you have some friends that have some pumps that want to come lease this up so I can get a royalty? And is it that simple?
Yeah. The problem is the reserves are really well known. These shale plays are all mapped out. There's no exploration anymore. Everything's really just production. So before you just buy a piece of land, you would already know if the reserves are there. The days of exploring for reserves are gone. The world is really just about producing known reserves at this point. So no one's out exploring new areas.
So then that brings me to this question. Then how viable is it? Right, because one of the things that was really interesting to me initially was that all of these reserves are in opportunities, or a lot of them, right, are in opportunity zones. Mm-hmm. So how do you? Are they way more expensive because they're known reserves of oil?
Oh yeah. So 20 years ago, what used to cost you $200 an acre to lease will cost you $50,000 an acre now, right? To lease the same land in today's world that what 20 years ago was an unknown. So in unknown days, people would pay very little for the right to explore. And if they found it, there was great margins. The known areas have very costly entry points because the reserves are pretty much known. So it's all baked in the cake already.
So do these major corporations, Shell, Chevron, Exxon, all these corporations, right? Do they have like dibs on all these reserves? And are you leasing it from them, or are you?
That's a great question. So a big oil and gas question, right? So yes, most of the premier reserves in the U.S., not all, but a lot of the premier reserves in the U.S. are already locked up by the majors. And so yes, right now in this world of ESG, a lot of what we're doing is just joint venturing with the majors in their areas of operations as they quote unquote decarbonize. But that's just kind of our strategy, right? There's a whole bunch of strategies that a lot of private equity shops will buy land adjoining theirs, hoping that someone will drill it and then sell it to the majors. It's all kind of a hodgepodge of different strategies in the energy space as to what people do. But yes, the majors have a lock on a very big chunk of the best acreage, if not most of the best acreage in the U.S.
And then, so you have to JV with them or whatever. So how does that work, with your tax deferral situation?
Yeah, all the same tax laws apply, right? When you're drilling new wells with them, you get all the same tax benefits. So whether you're in the, you asked about the home run. I think the opportunity zone is the biggest home run because you get all that compounding, all that deferral, and everything turns into tax-free, which I love tax-free. Right? But there's a whole bunch of other structures that can be utilized in the energy space. From tax law. So sometimes people will take a much lower degree of risk and they want to do a 1031 exchange. And people, I don't know if people know this, but Oil and gas is real property. So
Okay.
a mineral right is just a direct title, not normally done through a DST, not done through a Delaware Statutory Trust. They're normally done as direct title. And so people will literally exchange their investment in real estate through a QI into a title of land that gets an overriding royalty from the drillers. So they're kind of a passive interest holder where they just get a ton of revenue and they own that in perpetuity in direct title. So that's a really common way of using oil and gas. There's a little riskier way they can do working interests, which is a part of the mineral where they're just owning certain wells. So then they're just buying cash flow. So the well's already in production. They know the decline curve and they're just buying cash. So someone who wants a lot higher cash flow might buy a working interest. Someone who wants a much longer term investment might 1031 exchange into a mineral interest, right? And then beyond that, probably the biggest tax law arbitrage in energy are new drilling funds that are just done for tax benefits and cash flow. And people can set those up as either independent pig pails, where they generate all these losses against income, or they use them as an above line deduction, because they're normally able to take 70 to 90% of their investment and reduce their ordinary income every year. So there's all these amazing tax tools. If you find the right investments, you like what you're doing, you like the energy space, whether it be oil or natural gas or a combination, what are called liquids, kind of the methane, butane, isobutane, all those propanes, whatever your mix and your belief is the best commodity, you can pretty much choose anywhere in the value chain and take advantage of all those different tax arbitrages.
That's super interesting. So you mentioned you can like 1031 into like oil and gas reserves and that type of thing. So, but what is the biggest frustration that you're running into with the 1031?
So I think some of the biggest frustrations in oil and gas are, one, DSTs are very difficult to do because of the 7 deadly sins. So you have to do them as direct title. So it's a little bit more frustrating because you're titling so many different components to so many holders. I think some of the biggest frustrations that we've had historically, and I think are historically true for the industry, are that there's often a disconnect between buyers and seller in price. There's not always enough sellers when there are buyers at the right price sets, right? So finding that happy medium where sellers will sell at a low enough price that buyers can really make a good arbitrage. It's changed a little bit in the last couple of years because the largest holders of things like minerals were endowments and pensions and universities, because real estate doesn't generate UBTI, right? Unlevered real estate, which is minerals. So they owned the majority share of minerals in the US. Well, the ESG movement has forced them, the environmental social governance, to divest of a lot of these. So now the market's actually really rich with mineral interests, even though the timing should be that they're hard to find because prices are high. There's actually a plethora of them to find because there's so many parties divesting from energy. So there's a lot of sellers out there, which means it's a really good buying opportunity. And normally those two things don't meet, right? That's my biggest frustration, is finding sellers who are willing to sell at a good price is usually hard. Usually it's really wealthy landowners who know the value and refuse to sell it at a reasonable rate for investors, no matter what the markets are doing. Right now, that seems to be in kind of a middle ground where you can actually find good. So my biggest frustration historically is that although the tax law always works, you can't always find good investments in the energy space in minerals.
Yeah, and it's a time thing too. Like you don't have that much time to do it.
So yeah, it's so quick. It's so fast. I mean, because but if you're locking down a mineral and you get a good buy, you have 30 days to close. So if you don't have the ability to close 45 million in 30 days, if you don't have enough partners, if you don't, whatever the companies that do it, the timing is very, very tough. It's not something that'll hold on for a long period of time for a closing. If you're going to buy it, you got to buy it quick. You got to have a lot of cash on hand.
So interesting. Okay. So you mentioned that a lot of them, when you're 1031, and so are you using Delaware Statutory Trust to 1031 into these mineral rights and land? Like, can you do it privately?
Usually it's done privately in the energy space, or they're using a loose LP structure that really is just direct title.
Yeah.
Because the Delaware Statutory Trust, the odds are you're going to fail one of the 7 deadly sins. So it's a really hard structure in energy to do effectively. Yeah. There are a couple of firms I've seen out there in the US that have done them. So I don't want to speak for everyone, but in general, it's pretty tough to use the DST structure in energy. The master lease thing just doesn't work very well. Yeah, no, that makes a lot of sense. And I want to clarify something. So when
when we do a deferred sales trust, it's different than a Delaware statutory trust. Same DST acronym, which Delaware kind of created a little bit after us. But
No,
anyway.
the deferred sales trust would work. The Delaware statutory trust is a little harder.
Yeah. So speak to how the deferred sales trust is different than something like a Delaware, and how it would pair up with the energy benefits.
I haven't done enough of them to actually be an expert on the almost everything I've seen and been a part of in my history. 20 years has been direct title. So it's just, at the end of the day, when you get through the legalese, it just becomes too difficult. So most of the transactions that I've seen for the last 20 years have actually been direct title.
Interesting.
Yeah.
So just to kind of go back on that a little bit. So the deferred sales trust, what's unique about it, and maybe you can shed some light on it, is that you basically can. It's not technically the same laws or anything like that, but in theory, right, it kind of works like 1031ing into a self-directed IRA account type of thing, right?
As long as the ultimate asset that you buy is in essence direct title, right? You're using an intermediary to get there, right? Where you're creating your own what you call IRA.
You set up it's a business trust. So you set up a business trust that's able to joint venture with you and go in and like invest in other properties, other assets, oil, gas, energy, whatever you want. You can invest in whatever you want. And so as long as it's for business, it's totally good. So, I mean, with that, you're deferring the tax along the way, which is kind of where the IRA concept kind of comes in, right? You can kind of self-direct it a little bit, which is kind of where like the self-directed part comes in. You have to use a kind of like a intermediary, which is kind of where like the 1031 part comes in. So there's all these different things. It's a hodgepodge meld of a bunch of different things that has its own tax law and everything. And you guys can learn more about that at Capital Gains Tax Solutions.
I'll actually call you and we'll talk about that. So
yeah, absolutely. Well, we have a mastermind every Friday at 10 a.m. Pacific and 1 p.m. Eastern. And, essentially you can come and learn. I'll definitely invite you and learn about all of that stuff. Come ask questions, learn about it. Because I think, what's unique about the deferred sales trust is that you get this business entity that only does business with you, that has so many options and flexibility that you can marry so many different things. For example, if someone has like a mortgage over basis, okay, we'll do a Delaware statutory trust, right, to solve the mortgage over basis up to their basis, right? So let's say they're $500,000 over basis. We'll do a Delaware on that $500,000 and get them down to their basis, and then we'll pay off their debt, whatever they have, right? And then we'll put the rest of the money into a DST where it's all deferred. So they're getting some of this like Class A, kind of cash flow coming in from the Delaware REIT type of, investment where they're really hands off kind of thing. And then they're able to kind of self-direct the rest of it into whatever they want. So it's a great tool to work in tandem with other tools, kind of like you're saying, like with oil and gas and opportunity zones, the deferred sales trust with other things. And I would love to see how those two partner up together and how you can, use the DST to invest in the energy and just blow it up even further.
Yeah, we get a lot of that where so people will do the same thing in oil and gas in what are called like drilling JVs or partnerships, where they'll use the intangible drilling cost portion of the deductions to wipe out boot in a scenario. So we see a ton of that in a different medium in oil and gas that people will use for the same concept, right? So very similar. Yeah.
Interesting. Yeah, we'll have to dive in more about that. We're kind of coming up on our time here, so I don't want to cut you short, but I have like a couple questions. I want to get into the lightning round with you really quick. So, Matt, what's your favorite book?
Ooh, still to this day, probably Atlas Shrugged.
Atlas Shrugged.
Shrug.
What's it about?
It's about capitalism.
Okay. Awesome. And what's your favorite leadership quote?
Okay, it's coming from my mother-in-law, deceased, and this is because it's hardest for me to do. She said, "God gave you 2 ears and 1 mouth. Use them in proportion."
Listen more than you talk. I love it.
I love how it's your mother-in-law.
It's stuck with. I'm not the best at it, but it's stuck with me.
Hey, fair enough. Fair enough. What are you most curious about right now?
Opportunity zone, tax law updates. If in any of the HR bills that they're focused on, there's some potential for some really good improvements, and I'm hoping they extend this really amazing tax law.
Yeah, absolutely.
Cool.
And last question: what's the best piece of advice you've ever gotten?
Ooh, outside of the one I just gave you.
Outside the one you just gave me, yeah.
So it actually comes from my first mentor, who was my uncle. And I wish I could say it in an eloquent way as he did. But in essence, it was that my perspective is usually wrong, especially when dealing with your wife. So ultimately, try to think of everything from her perspective, and you'll have a very, very happy life.
Yeah, that's basically like, yeah,
She's always right.
Yes, but not just saying it, trying to actually get into her shoes and think from their way, since that's about the most opposite you can get from yourself is usually your partner. It's really good advice to help yourself learn other perspectives is to try to think like they think.
That's an interesting idea. I love it.
I
Definitely.
got to get off here and call my wife because
She called me like 30 times.
something, I don't know.
But anyways, all right. Well, Matt, thank you so much for coming on the show.
Any
Where can people connect with you?
Yeah, so USEDC, which is U.S. Energy Development Corporate, USEDC.com. You can find out all of our information. It'll have our LinkedIn pages and other information. So connect with us. We'd love to talk to you about the energy space. We'd love to talk to you about tax law. I mean, it's just my favorite topic. And hopefully you'll have me back and we can dive deep in some of the other verticals.
Yeah, absolutely. I'd love to have you back. Awesome. So connect with Matt. You can also connect with him on LinkedIn. If you just search for Matthew Ike, MATTHEWIAK.
Yeah, it's a weird spelling, right? IAK.
Got that right? Awesome. Cool. All right. And thanks again, everybody, for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is the best way to exit your highly appreciated assets tax deferred so you create, preserve, and grow more wealth. Please rate, review, subscribe. Thank you again, Matt, so much for coming on, man. I had a blast learning about that. Concepts just blew my mind that I have to go dig in deeper and learn all about. So thank you so much. I know our listeners got a ton of value from it, and we'll catch you guys on the next one.
All right, buddy. Be well.